Hey guys, how you doing? I trust you are all well and that you've had a fantastic week of trading. Well, this week that you've been away. So let's have a look at what's happening. Where we are at the this present time today is quite interesting because we are in the beginning of the new month. And you can see with the price action that's in front of us that December is poised to create some pretty exciting price action. Be careful about that, not moves, because when I say moves, I could be probably describing a trend. So let's have a quick look on the monthly charts. It's the beginning of the month, and really at least the very first day of the month, if not in the first few days of the month, irrespective of the time frame that you're trading, you just got to take the time to have a look at the month, put in place any key levels of resistance and support that you're seeing. And then, unless you're trading the monthly time frame, then just forget about it once you've put them in on your charts. And, as they appear in front of you, then there is a key level that's taking place. That's about to hit the market. And there will be some form of reaction on any monthly key level of support and resistance. So 7 markets that we trade in. Let's start with the Nikkei 225. Now, here's what's interesting. All-time high is also the high of 2021. So that black line that we have. Down here, we have the low of 2021, that black line. Then this dotted black line is the middle of the year's range. So the trading range of the year, that's the high, that's the low, and that's the middle of the range. Now, that middle of the range, if we didn't have any other key factors in the particular year, like the high of 2020, would become the magnet, especially if you're close to it. So that's a magnet that could draw the market up in December. So if on a lower time frame, you're seeing a bull trend unfolding before you. All right, that's just my daughter who's dropped something. You got bull trend unfolding in front of you, and you see this level of resistance coming up. Be very careful how you trade into it. Either be taking profits or look and see if we have a breakout above that, pull back. And if there's a bull trend, then you got to make sure that you're in the acceleration up. If a reversal is setting up and you get your reversal patterns, then you got to jump in and make sure you try and get in early if there's a reversal trend that's set up, because that level of that magnet, that level of resistance is strong, midpoint of the year, pretty strong. And the bears defend it, of course, because the bears don't want the market close above that. If they defend it and the market turns, you want to jump in early, okay, and just take that acceleration down. Now, I said if there's no other forces affecting the market, we are at the end of the year, so these are very important. The high of 2020, and you can just see the previous month tried to close beneath it, failed, closed almost at it, opened on it, and now we just bouncing off that as well. Okay, so what's going to happen? What do you think is going to happen? Well, now you have 2 magnets, okay, 2 key levels, horizontal levels. This resistance level up here and the support down here. So overall, the market has been just going sideways. If you now look at the year, looking back, so what's happened this year? Well, it's been, trading range price action. Unlike, if you look at the previous year, couple of strong bear months and buying into the close, and then just bull acceleration. So, that was a decent bull trend for the year. But this year, sideways price action. Now we are just looking at price action, right? As price action traders. I know my colleagues who understand the fundamentals and what's driving the market will explain to you why what we're seeing here is taking place. But as a price action trader, it really doesn't matter what's happening in the world insofar as how you trade the markets, because you just look at the chart in front of you and you can interpret it, and you can start to take your position from there. So beginning of the month, those are the two levels that you want to leave. You just want to leave them on your chart. So I know if I get to see a horizontal dotted black line, it's midpoint of the year. If I see one of these solid blue lines, I just pop it up and say, okay, that's the high of last year. So I'll just watch out for that. But on an overall perspective, expect trading range price action, which means once you go down to the weekly time frame and the daily time frame, even if you jump into a strong trend, bull trend or bear trend, you always got to be conscious in the way of possible reversals, okay, which is fantastic because I love reversal trades, okay. If I can see a major trend reversal setting up, and we spend a lot of time on it in the early part of the year, and I've said major trend reversals in terms of probability of success, I mean, they're pretty low. We're talking plus or minus 40%, which means if I take 100 major trend reversals in the year, I'm pretty happy to lose 60% of the time, because if I manage my trades well, I should not be losing more than my initial risk. It should be less, because you can manage your trades and see, okay, things are turning and come out of it. Of those 40% that go your way, if you take all the major trend reversals that set up, man, we're talking now of 5 to 1, 6 to 1, or if you want to think of it in terms of percentages, 500, 600% return on your initial risk. And that's the beauty of it. When you're able to get into those trends, you just want to just ride them and make make very good returns out of that. So in terms of money management, and that's something that we'll spend a lot more time going through, in our conversations next year, because I think a lot of traders do not understand money management. You can make a good return, good living from trading if you understand price action, and if you understand your own personality, your own psychology. You can make very good returns out of that. But if you want to accelerate your returns, you have to become a master, not just of price action or the self, but also of money management. So, but we'll dwell a lot more on that as you go into next year. At a broad level, you need to have an understanding of your strategies. Okay, out of the strategies that I trade, which ones can give me these huge returns? If I get in and I manage my trades well. So like major trend reversals that we're talking about, if you get in, you manage, you're talking 5, 6 to 1, if not even more returns. Okay. On the other hand, in my basket of portfolio of strategies, I know that when I'm in trading range price action, I really want to be, if I was trading this as a monthly time frame, and I've detected, analyzed, diagnosed that is trading range. You want to sell at the top of the trading range, and you're selling back to the middle of the trading range where you want to take your profits. Okay, because it's trading range price action, I'm not expecting that of a huge acceleration. And when we're down here in the bottom third of the trading range, I want to be buying at the bottom of the trading range back to the middle. Now, those kind of trades, there's a lot of them, so and because there's a lot of them, you're in and out of the market quite rapidly on any time frame, and even the monthly time frame. If you're in beginning of the month, whatever, you got to get out somewhere halfway through the month, got to wait again. On a 5-minute time frame, you're constantly in and out, and you're only taking 0.5%, half the reward of your initial risk, as opposed to the 5 to 1, 6 to 1 that you get on major trend reversals. Now, when you understand those extremes on your break-even equity curve, and you bring that together, then you start to make accelerated returns. But you need to understand money management. So that's another subject that unfortunately most traders don't understand, and I think we actually do ourselves an injustice by not dwelling into that. So next year we'll spend some time on that. Okay, the UK 100 which is a derivative of the FTSE 100. So basically same price action charts, but the price levels will be different. Just hold on a second, guys. Sorry. Sorry, guys. Okay, so UK 100, same kind of analysis you need to do. Remember, I'm showing you on the 7 charts that we trade. Do this on any chart that you're trading. If you just trade in a basket of currencies, five currencies, 6, 10, you have to go through this kind of analysis so that you're not guessing your way into the market, but you're actually trading through the market with a high level of intelligence. High of last year, high of this year, 2021, low of 2021, middle of the year, okay? And you can see how we just kind of bounced off that level. I mean, that level, when you were there, when you're bouncing off it, we hadn't had the high of the year, but it has turned up to be the middle of the year. So as a price action trader, you always got to find this thing fascinating and say, well, who's been creating that trading range? Along the way, resistance, support. And you got to assume that the algorithms or the computers that are trading the market are intelligent enough to be looking at all the previous price action and kind of figuring out where they want to push the market to end. So that becomes a midpoint, right? So that midpoint of the year is a very strong magnet, a level of support that can draw the market down. But if it pulls the market down, when you get to here, we're not going to expect all of a sudden that, oh my goodness, I'm going to stay in my shorts because we might just get down to this low, because then we're ignoring the trading range price action that's evident in front of us. So again, this particular market, you be traded as a trading range. And if you look up here, you can see there's an attempt to break above that trading range. Now, bulls who are smart, expert traders would have seen that, and they would have immediately started selling there. Okay. Why would they start selling there? Well, because they know most breakouts above trading ranges fail. So every time the market got to this high, they sell, take the profits, get back, they sell, they keep selling. And sure enough, they would have put an appropriate stop. What's an appropriate stop? It's a measured move above the trading range. So the stop would have been way here somewhere. And the market would have turned back to the middle of the trading range, take your 0.5% risk, boom, it's a trading range strategy, and that's how you make your money and you bank it. So big question now is, where is the year going to end? That market is likely to pull the market down, to just carry on the trading range price action. If the bulls are strong enough to try and push the market up and close near here, as you enter into the new year, you got to be thinking trading range price action, because the bears who created all of this will just jump straight back into the market. So that's got to inform the way you look at this chart. And when you go start stepping down to your lower time frame charts, you must bear that in mind. And obviously, the further away you are from the monthly time frame, okay, because this is the beginning of the month, on a week-by-week basis, then you have to do the same analysis on a weekly basis, looking at your weekly support and resistance. Then on a daily basis, you just have to put in the work and do the same analysis. So your weekly is all set. What's the daily levels of support and resistance? What's the market doing? Then you jump into the time frame that you're executing off. So is it a lot of work? It's a lot of work. But if you want to make money in this business, it's a lot of work. You're not going to get paid just by coming in to do a bit of guesswork. So let's put time in the work. Let's enjoy it, because the more analysis we do, the more these price action patterns just start to pop up around us. So as much work as you do, beginning of the month, beginning of the week, beginning of the day, it's as much work as you ought to be doing on any chart that you are trading at the end of the day. Okay, so forget about whether you have made money or not made money. At the end of the day, you need to kind of print out your charts if you have the ability to print that out. If you don't have, just take a screenshot and write notes on your charts. I mean, like I started doing here, you got to do the analysis. Okay, what happened today? Okay, the market is closed, or it's 24/7, but you're no longer trading. Where did I see the opportunity? Did I take them, they execute, or didn't I execute them? And if I didn't execute, what was going on in my mind that caused me not to execute? Okay, if I executed, did I execute on strategy? Big tick. If not, why not? But you got to do that post-mortem. You have to do the post-mortem, because the more post-mortems you do, they inform the pre-mortem. They inform what you look at before the market starts to open up before you. Okay, so that's the UK 100. S&P 500, extremely fascinating. Now, we spoke about this many times. This deep correction here that took place in 2020, trading range high, low. The bulls breaking out above that obviously had the measured move in mind. That's why measured moves are absolutely critical in terms of us deciding, I'm going to take a trade and I'm going to hold on to the trade. Okay. If you were trading reversals and you kind of see a setup within here and you take it and you say, okay, this is one of those trades which, if it goes my way, this fits into my major trend reversal strategies. If it goes my way, if I manage it correctly, I'm just going to hold it until I measure move and make my 5 to 1 return, 6 to 1, whatever it may be. And if I get stopped out, well, it's within those 60% that I lose. That's fantastic. We just wait for another opportunity. But if you jumped in and you got to wait for the measured move, right? This could be on a monthly, weekly deal. It doesn't matter what time frame it is, because markets are fractal. But in any case, the market reached the measured move. Isn't that fantastic? Tried to break above that, failed. Okay, so the goal of the bulls has been achieved. That's what they wanted: get to a measured move, take your profits, etc. And as it ends out, it's happening towards the end of the year. But what then is likely to happen? Well, we have the high of the year, low of the year, we have the midpoint. So having reached a measured move target from breaking out above this correction, deep correction and trading range here, which was the low of last year, and having broken out above the high of the previous year, that midpoint is a strong, strong magnet, okay? And it can pull the market down to create a double bottom here, right? Having reached a measured move, failed breakout above it, little trading range, failed breakout above that. If the bulls return into the market for another acceleration up, okay, they have now to really demonstrate strength to kind of say, well, this failed breakout was just profit taken into measured move, but we're still in the market. We're going to break above it with strength. And if they break above strength, which means they have to close pretty high up above it, probably higher than the measured move of it, and have a candle close near the top. If they do that, then they're setting themselves up for more acceleration in 2021, because then they'll be saying this low plus whatever new high they create, measure move of that somewhere in the stratosphere. But having seen that, we cannot ignore these two key levels: measured move achieved, the high of the year, and this magnet. So if I was looking to trade, which I will be, because I'm going to be working and trading up to the 22nd of December. So I'm going to have that low marked. Let's just do that while we're here. Okay. So I'll just use red, which I use for my weekly levels of. Okay, so that low of last month is a key level of support. I'm going to leave this blue line in here because that was a measured move. Okay, and that's a high of the year. So we've got three key levels here. But if the market breaks beneath this level and I get a setup, I'm going to take the shorts with confidence on my time frame, because I still think, this is a key level, the midpoint. This low is also a key level that can pull the market. Does not mean that we're going to get a bear trend breaking down there. But if you look on the 5-minute time frame that I trade, I mean, there is enough room within here on different days to get those 5-to-1 whatever returns that we're looking for, because I'll be trading into a trend. So that's immediately on my watch list. But remember, this is a monthly time frame. So, this week, with all the news announcements that are taking place between now and Friday, unless you really want to just get the experience, probably there's no need to jump to the market and trade. Let all the news filter through the market. Start with a new week when there is news, but not as dramatic news announcements as we have at the present moment. And then, start to look for opportunities to trade. Same kind of thing. The monthly will be set up, then you go into the weekly, go into the daily, choose your time frame, and we execute off that. Hang Seng 50, top 50 companies, Hong Kong Stock Exchange. Very interesting market to trade. This I was saying on Trading Buddies, Jeff and Ash's show, that this up to yesterday, I decided not to trade the last 2 days of November, because I had very good wins on Wednesday, on Thursday and Friday off the Hang Seng 50. Okay, so I didn't want to risk the super profits that I made, so I just left them. But what's fascinating about this particular chart, if you're going to trade it or if you already traded, for me, there's just the little bit of a diversity it brings in terms of staying ahead of like the Hong Kong exchange time. It's interesting, when they close the market completely dead, nothing happens. Wait for the market to open. So the open and close during the days, it's good to know when they close, when they're opening. But I've hardly noticed huge gaps in that period. But when it closes for the day, which it does 9 p.m. my time presently, which, depending where daylight saving is taking us, about 7 p.m. UK time, 7 p.m. GMT. When that market closes, and then when it opens again, 3:15 a.m., so just 1:15 GMT presently, typically you got gap ups and gap downs, okay, which are not a problem, because as a price action trader, for example, just look to the extreme left here. This is on the monthly time for that gap up. We know how to trade the open of any market. Okay, so if you trade in this particular market that actually closes the exchange, when it opens up, you see a gap up, you know what to do. If you see a gap down, you know how to trade it. When you trade the open, it's a completely different strategy, because we're looking for opening reversals, or we're looking for breakout into trends from the open. Really fascinating stuff. And if you're able to manage that, you can make pretty good, decent sized returns. So on this particular time frame, which we're not going to go into, because I want to just give us the monthly view of everything. We had trading range price action. I was in particular trades, and I decided to, because of what I could see on the charts, inside candles. So here I go again, getting sidetracked. I'm actually glad that my wife is not my investment manager here, or my risk manager. Because you say, George, there you go again, just stick to the plot. Now you're getting sidetracked. In any case, so I'll show you very quickly. This is where we were at, and I'd spoken about this previously before, in terms of if the bears are strong enough. I'll take this off just now when you get back to our monthly time frame. So when we're down here, if you recall, and we kind of said, well, low presently, high, the bears are strong. If a break beneath that, want to get to a measured move. I mean, you've absolutely got to love the precision of these measured moves. And I think I kind of speak about them over and over and over again because they work so precisely. And the more computers jump into the market, the more we love it because everything becomes even more precise. So algorithms are creating and they are searching for measured moves. So that measured move, you thought, okay, if the bears are strong, they want to get to that particular measured move. So I was on the 5-minute time frame, okay, because with that particular candle, I said to myself, yep, I know I'm at the bottom of a potential trading range, but I like the bearish price action. And if the bears are strong, we might just get acceleration down. So taking trades in here, and then you get an outside candle, you get an inside candle with a small bear body, that is breakout mode. Okay, so as the day is coming to a close, you kind of feel, okay, where's the appropriate place to place my stop? You got to figure out where to place your stop appropriately. Then you got to decide and say, okay, inside candle, inside, outside candle, inside. It's a strong breakout mode, which would favor the guys who are controlling the bodies of the candles so far. And the bears are controlling the bodies of the candles. So took the trades and just left them in the market on the closure. Go to sleep peacefully, knowing if you get stopped out, initial risk, if there's a gap up and you get stopped out, well, you might get slippage, which is fantastic as well, isn't it? Which means you have to appropriately trade size. So if your maximum risk is 3%, 1%, let's say 1%, that's maximum risk you prepare to take on each of these charts. So that at any given time with trade management, you're only jumping in when you've got your 1% that's now free on a particular chart. So you don't overexpose yourself. So you can break that down into little chunks and go in a quarter risk. Okay, take some profits out, leave a quarter, leave half in. But those are decisions that you make. But stop must be in the correct place. Of course, you can always get stopped out. But in any case, the gap down that we had and the acceleration down, worked out beautifully in my direction. So achieved very good returns, and it was part of why I didn't want to trade any further. Let me just check questions before we go back. Does the measured move theory also apply to currency trading? Yes. Measured moves on any market. I learned measured moves just trading currencies for years. By the time I started putting in indexes, it was just continuation. So yes, currencies 100%, because that's where I started. When I learned about them, I started using them. And then you just apply them on all markets. And you use them to see hidden levels of support and resistance, where you want to initiate trades, where you want to take profits, or where you say, but hang on, what's happening? Why is the market turning here? Well, it's turning there because there is a level of support or resistance that you may not have picked up, but it is there. And just practice them as much as you can. And really, it doesn't matter what strategies you trade in or what you got in your charts. Measured moves have got to be part of your bread and butter analysis. All right, so let's not get caught up in what happened. Let's look at setting up for the month so that we can pick up all of these other trades as we go along. Okay, so what we have here: high of the year, low of the year, midpoint. So we've accelerated way below the midpoint. I mean, you can see, this strong bear candle. When you look back now, I say, wow, that was strength. But the bears really made a statement that this year, at this present moment, is likely to end up as a bear candle, right? Opening up here and closing down here. That's where the bears want to take it. And if the bears want to do that, what to be their objective? Well, you got to be thinking, okay, high, low. Bears will be saying, if we're able to close December, with a strong bear candle, then we can set up for next year, breaking beneath this trading range and go for a measured move. Okay, then try and break beneath the low of the previous year and just demonstrate strength. On a price action basis, just a quick note, most gaps close. So even if you see a gap up or gap down, at some point, it may take a long time, but it would close at some point. Okay, so what are the bears pressing for? Already we have a new low of the year, and all the bears want is just continued price action separation from the middle of the year so far, which you've done, but also this midpoint, high of last year, low of last year. So that for the bears becomes key. They don't want the market to come back and close above that midpoint of the previous year's range. You want to show strength continually, so the bears are going to try and press down here. So this low of 2021 remains on our charts. And if we see that popping up, we'll know, okay, that's the low of the year. Then we really going to be looking whatever time frame for breakouts beneath that, pullbacks and test, whichever way you trade your breakouts. So in terms of moving averages, good question. And I have to keep apologizing to all you guys because sometimes I forget to talk about it. There are two moving averages that I use to trade. Okay, I got born, bred, fed, wind, whatever it is, on the 20 EMA. Okay, because for some reason computers tend to respect that quite a lot. So 20 EMA, any bounces off that in a trend, you want to take those trades. Any bounce off that in a bear trend, you want to take those trades. Now, what I have on my charts, which is for my own experience, because I started noticing that I would always draw a lot of trend lines which are removed from the 20 EMA. So this is a 10 EMA, okay, but assume this was a 20 EMA. I started noticing that, I'll be trading and I would always have lines like that, which were fine because I say, okay, so that's good. So there's a breakout there, but there was my 20 EMA. And I'll be waiting to get a pullback to the 20 EMA. That's if I haven't taken a trend reversal trade earlier on. But then I figured out, but hang on, since sometimes I noticed that the market would bounce off this trend line a couple of times and then have a deep reversal beyond the 20 EMA and set up a reversal trade, which I could trade down or maybe a continuation. But I really said, but I need to get in those trades. So I got frustrated just trying to keep on drawing the lines because I like clean charts. I don't like. So I just said, well, let me put it was that simple. I wish it was clever. I just said, let me put a 10 EMA and see how far these trend lines I draw in a breakout are from the 10 EMA. And lo and behold, 90% of the times, the market was hugging the 10 EMA or just off the 10 EMA. And the more I saw that, so I would have there are a few things on my charts that I've got to move around so I can see what I'm doing. So I would have, okay, so I would have a 20 EMA. So that's a 20 EMA exponential moving average applied to the close, right? So that's what I used to trade off and just wait to see if I get pullbacks to it. But then when I started putting the 10 EMA, I saw a lot more opportunity, same kind of thing. If I see a breakout staying above the 10 EMA, I want to trade a pullback that comes off that. So then I started using both. And as time progressed, because you kind of start to get a sense that, okay, the market is bouncing off the 20 EMA. I just decided to take off the 20 EMA and leave the 10 EMA on. Okay, so I use the 10 EMA as an indicator of strength of a breakout, and that's where I want to jump into trades. Okay, and if the market pulls back beneath that, you typically find there's a double bottom or double top, which could correspond to a 20 EMA. So there will be absolutely no problem if you want to put the 20 EMA as well at the same time. Okay, thanks, Peter. All right, so Hang Seng 50, we're going to look for more shorts, guys. So we'll leave this on when you go to the beginning of the week. So when you open up your charts on Monday morning or Sunday night, beginning of the week, put on your weekly support and resistance, and let's see if we can get shorts being set up. Oil, fascinating. Okay, let's just shift a bit. Okay, so oil, we have a high of 2021, almost a perfect double top with 2018. Now, remember how we trade. Once we see a particular setup, there's our setup, double top. We don't jump in and initiate shorts here, whether this is a 5 minute, 10 minutes, 24 hour, which is a daily, 4 hourly, whatever it may be. First, we see the setup, then we're happy chappies. Then what we want to see is acceleration beneath that, confirm that the bears are strong. When I see a pullback, we get a lower high, then we just jump into our trades when we get the setup, stop above here. Okay, so what oil is setting up for, if this double top is strong, remember you have to try and set to get what the market is thinking. Okay, the consolidated thinking of the market that's presented before you on the charts. If the bears who are creating this double top are strong, then what do the bears want? The bears want acceleration beneath this candle, which also happens to be just accelerating beneath the midpoint of the year. So if you're a bear, you say, hang on a second, we have a double top. What you want to do now is close beneath the midpoint of the year, even if that creates a bit of a dodgy and uncertainty in the market, but that's fantastic. But let's close beneath that low. So we follow through of the double top. Now, as the year opens, if we have, an attempt for resumption, that's perfectly fine. Let the bulls try and resume. And when we get back into this area, we'll create a lower high and accelerate it, right? On the other hand, in the same vein, if the bulls, after we have strong bear breakout beneath this low, then we're happy with the bear strength. If the market resumes, and in first quarter, we have a close above this double top, it does not mean that we're now into a bull trend. Because remember, we've said it, if you have a double top, a breakout above the top, and if it fails, what do you have? You have a 3-push pattern, you have a wedge pattern. Wedge pattern is evidence of greater strength by the bears who are preventing the market from breaking out above a certain level. So first attempt created the high. Second attempt, good for the bears, double top, good force. If they manage to let a breakout take and then a 2-bar reversal take place, third push, then there's acceleration beneath that. Fantastic, then we trade it short. So bias for oil for December. The bears are strong, even though with a bit of buying here, which is just a reaction to the high of last year. The bears are strong when I close beneath this, so I'm looking for shorts, strong beneath that. And hopefully, as the new year opens, we'll see what happens to create a lower high. If the bulls are strong, okay, and prevent the market breaking beneath here, I'm still holding on to the bears being strong because of the double top. The bulls are strong to give us a huge bull reversal candle that closes above the double top. Then you're going to say, hey, fantastic bulls, well done. Let's wait for January to see if there's acceleration, a follow through, and say, okay, bear case failed because of a breakout. We have followed through, wait for a pullback and accelerate. So we'll have a look at that as we go forward. So presently, I'm going to look for shorts and see if we get anything. Gold. Now, just by having a quick look at gold, you can say, my goodness, look at this trading range price action. We're going nowhere fast, guys. Okay. Good for the bulls last year, high of last year, low of last year, midpoint. Exactly where we are, midpoint of 2020. That's where we're just hanging around. Okay, we're at the high of the year earlier on, low of the year 3 months later, midpoint of the year, black line. Take this out. Midpoint of the year. So from there, we then have acceleration. So this level of resistance and this level of support, just hold on a second. So we have a level of resistance here, a level of support here, midpoint of last year, midpoint of this year. Now, what do you think is likely to happen? Nothing much except trading range price action. If the bulls accelerate to here, and we still have time before the holidays, if we're still in the market, when you get to that level of resistance, guys, don't be looking for breakouts and continue bull price action. I mean, you got to keep looking to the left. You know, like that old thing about crossing the roads. Look to the left. Look to the left. That's what we're going to look out for. So the market gets up to here, I'm going to be looking for shorts, right? If it gets down to here, bouncing off here, I'm going to be looking for longs. Pretty tight range, which if we create an inside candle, is just setting up for a breakout in the new year, but there has to be a lot of work to be done. The other thing that we've said, if you see trading range price action, you're like saying, man, George, what are we supposed to do here? Try and just pop up the line chart. And clearly now you can see from the line chart that, maybe not say clearly, these things are all in my head. I say clearly they're in my head. Let me show you. So what we now have is clearly a breakout mode patterns setting, a convergent triangle. The market is not going to converge and just end up with a straight line. At some point, there will be a breakout. So converging triangle, so breakout mode might not happen in this year because of that inside pattern that we've seen when we apply our candles. So if you just pop back our candles, you can see trend range prices. So my personal inclination is stay away from gold until we get clarity. Okay, unless you just love to, you don't have any other chart you want to trade, you want to trade price, trading range price action. Trading range price action is easily tradable. Buy low or sell high and scalp in the middle, but it's a lot of work. And if that's what's presented to you when you're in a particular market, then trade it. But I don't go looking for it unnecessarily. I don't. West Texas or US or no, I don't. And there's no reason to it. And you can trade it, same thing, same price action. I just choose Brent crude, UK oil. So you can trade that if you want to trade it. Finally, quick look on euro. We spoke about this many times, this trading range that was created here. And we say the bears are strong when I get to a measured move. So just now we got short of it, buying the close. So the bears didn't quite achieve their objective. So the bulls have come back to create a potential low here of the year. Now, what is likely to happen? Again, let's just look at any potential levels of resistance support that are before us. High of last year, low of last year, midpoint. Okay, so the bears, if the market closed here for the year, bears would be happy. Okay, because they have a bear candle for the year that's closing beneath the midpoint of last year. What do the bulls want? The bulls want, at the very least, the bulls want to have a close above that, because that creates a decent enough reversal. Doesn't mean that will accelerate, but we might end up in a trading range into 2022. Okay. In the event that we get such bull strength, they're going to have to fight through this midpoint here, middle of the year, which the bears will defend vigorously, because the bears are super happy that they're below the midpoint of last year. They're below the midpoint of the year so far, so they will defend that. So any attempts by the bulls will be met by by the bearish pressure. We just want to keep that low. So what am I looking for euro? Nothing much at the moment. I will look at it on a week-by-week basis, day-by-day basis. If I get, as the daily candles unfold, a setup that's tradable, knowing that the bulls have to try and break above this. If I see any bounce off that in distant reversal, then I'm going to trade it short. If I see a couple of bull candles breaking above that and they pull back on the daily time frame, then I'm going to trade that going along to see if we get to that extent. All right, guys, I hope I didn't go too far for you, but please put in some time on your monthly analysis. And as I said earlier on, into next year, I really want to start talking about money management, because we don't just want to be profitable traders, we want to be super profitable traders. We'll catch up next week, guys. All the best. And thank you very much for participating and commenting. Guys in the office, thank you. Take care.